A 9% dividend is no joke, but with oil prices bouncing and market volatility rising, we have to ask, is PH Energy really a reliable cash cow? Or, well, could they be a value trap in disguise? Fasten your seatbelts, folks. This is going to be a good one. You may not have heard of PHX Energy, as they're not a company that comes to mind when you think of the Canadian energy sector. The fact that they provide drilling services to a lot of the big oil companies, that that does make it easy for them to get overlooked. However, you gotta give them credit. They are one of the top drilling service providers, well, in the entire industry. Their drilling approach uses advanced tools that allows them to drill faster and more accurately. This has the result of reducing costs, decreasing operational risk, and maximizing their overall efficiency. They may be a small cap Canadian company, but they have been making a name for themselves as they're not just providing their services in Canada, they're also operating in the United States as well as, of all places, Albania. Of course, the fact that they have a dividend yield in the territory of 9% has also been helping them they're starting to get a little bit of attention from both dividend growth and income investors. This dividend is amazing, but when high yields are involved, there can be additional risks, and we are going to be looking to see if that is the case with PHX. Is this dividend sustainable, and could this stock be one of those uncommon stocks, both an income and a total return stock? A sub to the channel is the best way to drill into some future content. Their last quarterly report was for Q1, and as you guys know, I like to read through to find a few highlights. So in Q1 2025, they experienced a 17% increase in revenue over their Q1 2024 data. This was mostly due, well, thanks to growth in their high margin services in both the US and Canada. Speaking, of course, of the US, their US division, it experienced record revenue that was up 19% compared to Q1 of 2024. In regards to their cash flow, they experienced a $18.2 million in excess, which was a 144% increase over, well, Q1 of last year. So that's not too shabby. This year, they have now become the largest independent RSS fleet in North America. So RRS, that's the name of their drilling technology. It stands for Rotary Steerable Systems. Okay, that all sounds pretty darn good. But I do think we need to look at to get a true sense of things, we need to look at their fundamentals. You guys know, if there are numbers involved, we need to call on the wizard of weighted averages, the ninja of net margins, the one and only Mr. Math. We will, of course, start off with a little bit of their surface data. So at the time of recording, their current value is coming in at $8.93, and they got a market cap of $406.82 million. Their beta definitely reflecting some volatility at 1.66. Those earnings per share coming in at 1.24, and their price to earnings ratio coming in at 6.90. That's pretty low, but when you do look at their peers, overall, the sector is pretty low. The average is 8.10. A few of their peers include Akita Drilling, which has a PE ratio of 5.10, Precision Drilling coming in at 8.50, and Stampede Drilling coming in at 15.60. You want to bet Stampede Drilling is based out of Calgary? I wouldn't take that bet. I'm pretty sure they are. Looking at their price to book ratio, that's coming in at 1.70. That return on equity, 21.31%. Return on assets, 11.38%. These numbers look good. I have no complaints for sure. And of course, you guys know I'm pretty happy about that return on equity. When you got an ROE north of 20%, I tend to be a little on the happy side about that. Okay, it is time to drill a little deeper and take a look at their cash situation. When it comes to their revenue, that's coming in at $687.24 million per year, earnings $57.33 million. Now, those earnings are projected to grow by a nice looking 14.11% per year over the next 5 years. Their profit margin coming in at 8.34%. Looking at their cash flow, it's in the positive. We got a free cash flow of $12.45 million, operating cash flow 96.65 million. Let's take a look at that fair value. So once again, their current value $8.93, and when we use a discounted cash flow model, we get a fair value of $24.18. So that does paint them as being undervalued by 63.9%. Also makes me think of that low PE ratio. Well, yeah, we're seeing a couple things put together here. Looking at their target. So their 1-year target is currently set at $10.83. That's an increase of 36.27%. That's not too shabby. That I'm seeing some opportunity here for sure. These numbers, well, they're pretty darn good. They do, they do have a healthy cash flow for their size. So I'm liking what I've seen so far. Let's turn that page though and take a look at those returns. We'll start with, of course, their dividend. As I mentioned, we've got a yield 9.174%, quarterly dividend of 20 cents per share, payout ratio on that 64.8%. This number is better than I was expecting, and that's a good thing for sure. Keep in mind, though, that this payout ratio, it is based on earnings. And if we were to look at it from a cash flow perspective, well, it does come out much higher. In fact, it comes out into unsustainable territory. All right, let's just take a look at that 5-year average dividend increase. And this is a good one, 140%. Holy banana bread, that's not too shabby. Looking at their returns, we'll start with that 3-year. So 3-year return on investment, 64.04%. Factor in those dividends, total return, 102.57%. On their 1-year return on investment, 1.25%. Adding in those dividends, we get a total return of 10.31%. That's the sector. The sector definitely hurt this year. So we're seeing that reflected in these numbers for sure. But when we do look at that 3-year annualized, not bad, 26.53%. Okay, for the most part, these numbers are good. I definitely would love to see that 1 year go up a little bit. And right now, I have a feeling that might be happening. So let's take that final dive. Turn that last page and jump into their debt data. So when it comes to their total debt, that's coming in at 26.14 million. Total equity, look at this, 233.58 million. So that puts their debt to equity ratio at 11.2%. That's not bad. And I'm going to point out that in the last 5 years, they've been reducing that debt to equity ratio from 15.4%. So they are moving their debt in the right direction, no doubt about it. Cash and cash equivalents, they've got 13.97 million sitting there. That could pretty much cut their debt in half right there if they really wanted to. Looking at their assets, on the short term, they have assets of 228.74 million, beating those liabilities at 138.11 million. You know I like this. You know I like to see that. On the long term, assets of 221.30 million, liability 78.35 million. Nice. These are nice. These are nice. Overall, their debt situation is good. And these are numbers that come with a lot of wiggle room for sure. Their debt is well covered by their cash flow. And the interest on that debt is also, well, it's well covered by their EBIT. You know, those earnings before interest and taxes. Pretty good debt situation. If we look at their share dilution, they've had no share dilution. However, one small thing that is definitely worth taking note is that there has been some significant insider selling. In the last 3 months, they have seen just over 1 million shares sold by insiders compared to 13,000 bought. It's not a huge amount, but it's big enough that it's worth taking note of for sure. Okay, I do think we have enough data for the final verdict. I do like PHX, and I do see their dividend as something they can sustain. They are positioned in a good place within the industry with their drilling technology, and it's, well, the savings that comes with that technology. It's making it a well sought after service that more oil companies are definitely taking advantage of. This does make them a solid option for both total return investors and income ones at the same time. For total return investors, it is a great way to get some higher income into your portfolio with some growth potential. However, the growth will not be as big as part of the payoff for having higher dividends. Nonetheless, I do expect PHX to have some growth moments for sure. especially if you listen to those analysts, maybe sooner than later. For the income investors, it is a similar concept in that there are higher income opportunities out there, but yet, well, this one may be one of those stocks to provide a unique exposure opportunity to energy without the direct tie to the price of oil. Thus, perhaps even that might make them a more stable income flow. Either way, I do like what PHX is bringing to the industry, and I do think it could be an interesting stock to watch for sure. If you are interested in PHX, don't forget to put in a whole heaping helping of due diligence before you place any of your hard earned money on the table. Let's continue that learning journey by checking out this video on the big winners of 2025 thus far. Thank you for watching, and I will see you in the next video.